We've already looked at a repayment mortgage, and in this video we're going to look at an interest-only mortgage. It's fairly straightforward. A repayment mortgage is where you pay the whole amount that you've borrowed back, including interest and the principal sum, the original sum. And in an interest-only mortgage, you guessed it, you only pay the interest back. So let's have a look. You borrow, let's say, £180,000. The bank will charge you to borrow that money. So the bank will give you £180,000, and in return, over the length of the mortgage, which let's say is 25 years, that's what they typically are. They can be longer, they can be shorter, but we'll use the example of 25 years. In return for that £180,000, the bank will always want the £180,000 back plus interest, because that's how they make their money, and they're in it to make money. So, how is this going to work in a mortgage? You have the £180,000 that the bank has lent to you, and then over time you make payments. So every month you make a payment, and those payments go to the bank and they pay off the interest. And the interest, incidentally, on £180,000 over 25 years is a significant amount of money, and we'll make a video showing exactly how much interest you pay on a typical mortgage over the lifetime of the mortgage. So each month you're paying off interest when you pay your monthly payments to the bank, but the amount that you owe, the original sum that you borrowed, doesn't go down. It remains at £180,000. At the end of the term, after 25 years, you will have paid however much it is to the bank. It'll be 12 payments a year of a particular amount of money multiplied by 25. And that will have paid all the interest back, but you will still owe £180,000. And at the end of those 25 years, the bank will say to you, please give us £180,000. Now, if you can't do that, if you don't have £180,000 lying around in your bank account, you will have to sell the house to pay the £180,000 back to the bank. Why out an interest-only loan? There are several reasons that you might do this. You might have in place another saving plan that ensures, or that you hope will ensure, that will give you the lump sum at the end of the term, so that you can pay the lump sum that you've built up. You might have been putting money into this fund, which might be a stock market fund or something, as well as putting the money giving money to the bank for the interest. You might have been putting a certain proportion to the bank and some into this savings scheme, whatever it is. It could be an ISA or something, so that at the end of the term you've taken care of the interest, that's all sorted out, and then you can give this lump sum to the bank. That might be one way of doing it. You might have had no intention of paying the lump sum back, or rather of keeping the house at the end of the 25 years. You might have just used it as a way of financing having the house, and then you had every intention of selling the house at the end of the 25 years to pay the money back to the bank. Or you might have imagined that inflation was going to be so rampant over the 25-year period that £180,000 would be a relatively small amount of money after 180 years, after 25 years rather, that you would be able to pay it back. and the houses might just have been an investment that you were using for income and capital gain, and that you hope that the house will go up in value to, say, 300 or 350,000, so you can sell the house, pay the money back to the bank, and still have 120k left over. And those are the motives for having an interest-only mortgage. So if it's a house that you're going to be living in and you want security that it's going to be yours at the end of the term, perhaps an interest-only mortgage isn't the way to go. If it's an investment, then there is an argument that interest-only mortgages are useful. But be informed, whichever one you take out, understand what it means and what it could mean for you in the future.